There's a $7 trillion hole opening up in the global economy, and Wall Street has decided that you are the one who's going to fill it. While you're checking your portfolio and feeling safe because you own an index fund, the world's biggest hedge funds are quietly moving toward the emergency exits. They've spent the last 3 years building a mathematical guillotine, and today I'm pulling back the curtain on the secret sauce they're using to dump their overpriced garbage onto retail investors like you. Most creators will tell you to buy the dip, but they won't tell you that the dip is actually a bottomless canyon designed to incinerate your life savings. We're skipping the boring documentaries and the trust the process lies. By the end of this video, you will see the exact mechanism that turns the world's most famous stocks into a suicide pact for your 401k. Right now, the stock market is a tech ETF in a trench coat. We're told the S&P 500 is diversified, but that's the biggest lie in finance. 7 companies – Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla – now make up a staggering 32% of the entire index. This is the Magnificent Seven, but in reality, they're the 7 sins of Silicon Valley. For every dollar you put into the market, nearly a third of it is being gambled on just 7 CEOs who are currently facing the worst economic headwinds of their careers. These giants are trading at valuations so disconnected from reality that they make the 1920s look like a conservative savings account. We are talking about an average PE ratio of 42. In plain English, you're paying $42 for every single dollar of profit these companies make. Historically, when that number hits 22, it's a warning. At 42, it's a death sentence. This is the structural failure of the passive indexing cult. The logic is simple and deadly. Index funds buy stocks because they're big, which makes them bigger, which forces the funds to buy more. It's a self-reinforcing loop that works beautifully until the first domino falls. And look closely, the dominoes are already wobbling. Let's talk about Apple, the world's most expensive shiny brick. Investors treat Tim Cook like he's still inventing fire, but the reality is that iPhone sales peaked 4 years ago. Their biggest growth market, China, is currently breaking up with them to date domestic brands like Huawei. If Apple's valuation simply returned to where it was 5 years ago, $1.6 trillion would vanish instantly. That's not a correction, that's a cratering that would drag the entire market down 4% in a single afternoon. Then you have Microsoft, the supposed savior of the AI era. Satya Nadella says Copilot every 3 seconds to keep the stock price up. But have you checked the receipts? Microsoft is sending billions of dollars on fire to build server farms, yet the actual revenue from AI is barely a rounding error on their balance sheet. They are building a digital skyscraper with no tenants, and the rent is coming due. The secret the big firms don't want you to know is that the AI revolution is currently a $100 billion expense for the Magnificent Seven and only a $5 billion revenue stream for the entire world. When the CFOs of the Fortune 500 realize these AI tools aren't actually making them more money, they're going to cancel their subscriptions faster than a Netflix account after a price hike. This isn't a new era, it's a liquidity trap, and the teeth are about to shut. If you think your diversified index fund is going to save you, you're in for a $7 trillion wake-up call. Now that you see the trap, let's look at the bait. The biggest lie currently being sold to you is that Nvidia is a once-in-a-lifetime money glitch. Everyone thinks they found the secret to infinite wealth, but Nvidia is actually the world's most expensive middleman. They are trading at a price-to-earnings ratio of 58, as if the entire planet has an infinite appetite for $40,000 chimps. But here is the secret sauce Wall Street doesn't want you to taste. Nvidia's biggest customers are its own competitors. Google, Amazon, and Microsoft are currently pouring billions into Nvidia's pockets, but they aren't doing it because they love Jensen Huang. They are doing it to buy time while they build their own in-house chips to kill the Nvidia tax forever. The AI infrastructure build-out is a one-time construction project, not a recurring subscription. Once these massive data centers are filled with silicon, Nvidia's revenue isn't going to grow. It's going to crater, because you don't need to buy a new H100 chip every month just to keep the lights on. It's the same logic as the railroad boom or the fiber optic craze. Once the tracks are laid, the people who sold the steel go broke. Then we have Amazon. the everything store that is slowly running out of everything, including people. Amazon is currently facing a silent labor crisis where they have literally exhausted the entire available workforce in the US. Their turnover rate is a staggering 150%, meaning they are burning through humans faster than they can hire them. While they try to distract you with Prime Day deals, their cloud growth is cooling off and their international divisions are bleeding cash. Alphabet, or Google, is stuck in what we call the innovator's dilemma. Their new AI search is literally cannibalizing their own ad revenue. Think about it. Instead of clicking on 10 blue links where Google makes money on every click, the user gets one single AI answer and leaves. Google is effectively paying billions to build a tool that destroys their own business model. And then there's Meta. Mark Zuckerberg is still setting $16 billion a year in a virtual reality playground that absolutely nobody asked for. His metaverse is a digital ghost town, and his only saving grace is Chinese fast fashion apps like Temu and Shen, spending billions on ads to flood your feed with cheap plastic. If those companies pull their spending during the next trade war, Meta's growth disappears in a heartbeat. And don't even get me started on Tesla. Tesla is a car company growing at a measly 3%, yet it's trading at 73 times earnings because people think Elon Musk is a wizard who's going to launch a robo-taxi fleet tomorrow. Spoiler alert, full self-driving has been 2 years away since 2016. Meanwhile, their profit margins are being shredded in a global price war with Chinese manufacturers who can build EVs for half the cost. These aren't just companies. They are the 7 sins of Silicon Valley, and they are all interconnected in a way that makes them one giant fragile house of cards. The moats that supposedly protected these monopolies are being breached by open-source AI and changing consumer habits, yet you are being told to keep buying. You are essentially gambling your future on the idea that 7 CEOs can maintain a perfect streak of luck while the entire world is trying to eat their lunch. The era of cheap money is dead. Interest rates are biting, and the growth at any price model is officially broken. Your diversified portfolio is actually a front-row seat to a $14 trillion explosion, and the fuse is shorter than you think. This is where the secret sauce turns into a bitter reality for everyone who ignored the warning signs. If you've stayed with me this far, you're already ahead of 99% of the retail herd, but now we need to talk about the actual mechanics of the 2026 slaughter. The timeline isn't a guess, it is baked into the way modern index funds are built. We are looking at a 3-act tragedy that will redefine wealth for the next decade. Act 1 hits in the first quarter of 2026. This is the moment of the great AI realization. For 2 years, companies have been coasting on the promise that AI would magically fix their balance sheets, but the first quarter earnings calls will be the day the receipts finally come due. When the big tech CFOs are forced to admit that their $500 billion investment in GPUs hasn't actually increased their profit margins, the AI premium will vanish in an afternoon. This isn't just a theory, it's a mathematical certainty, because the cost of capital is no longer zero. Act 2 is the analyst capitulation. This is the part of the cycle where the suits on Wall Street who have been screaming, "buy" for 3 years, suddenly realize they're the ones holding the bag. One by one, the major banks will downgrade the Magnificent Seven from strong buy to neutral. In the world of algorithmic trading, a single downgrade is like dropping a match in a room full of gasoline. The bots that drive 80% of market volume will trigger sell orders simultaneously, creating a vertical drop that no human trader can stop. But here's the secret sauce they don't teach you in finance school: the Passive Suicide Pact. Because everyone is tucked into the same S&P 500 index funds, the fund managers are legally forced to sell the biggest stocks to meet redemption requests. This creates a feedback loop where selling leads to more selling, and because the Magnificent Seven are the heaviest weights in the index, they are the first ones to be liquidated. By Act 3, which we expect to hit by the third quarter of 2026, we enter the full-blown liquidity vacuum. This is where the price of a stock like Nvidia or Apple doesn't just go down, it skips levels. Imagine trying to exit a burning building where the door is only 3 feet wide, but there are 10 million people trying to get through it at once. That is what the 2026 market will look like. The market makers, who usually provide the bids to keep things moving, will simply step away from their screens. They aren't charities. They're not going to buy your overpriced tech stock while it's falling 10% a day. When the bids disappear, the paper wealth of the middle class evaporates in a heartbeat. We are talking about a 45% drop in the S&P 500 that will make the 2008 crash look like a minor speed bump. But why is this happening now? Because we've reached the limit of exit liquidity. The billionaires who run these companies, the ones who actually see the internal metrics every morning, have already started their exit. In 2025, we saw record-breaking insider selling from Jeff Bezos, Mark Zuckerberg, and the top brass at Apple. These guys aren't selling because they need a new yacht. They're selling because they know the peak hype has been reached. They're using your buy-the-dip mentality as their personal exit ramp. While the mainstream media tells you to have diamond hands and hold for the long term, the people who built the companies are moving their wealth into hard assets, land, and cash. They're leaving you to guard a house that's already on fire. So what is the actual secret sauce for surviving this? It isn't about being a bear or betting against the world. It's about understanding concentration risk. The real winners of 2026 will be the people who had the courage to step out of the index cult before the stampede started. The secret is moving into the forgotten economy, the boring companies that produce real things like energy, food, and raw materials. These are the stocks that have been ignored for a decade while everyone was busy chasing a chatbot stock price. When the tech bubble pops, the money doesn't just disappear, it rotates. It flows out of the imaginary growth into tangible value. But you can't make that move once the crash starts. By then, the exit door will be blocked by millions of panicked investors. You've been fed a diet of easy money and upgraphs for so long that you've forgotten what a real bear market feels like. A real bear market doesn't just take your money, it takes your spirit. It stays down for years, grinding your hope into dust until you finally sell at the very bottom. That is the trap being set for the diamond hands generation. The Magnificent Seven are about to become a case study in human hubris, a $14 trillion monument to the idea that this time it's different. It's never different. The math always wins. The 2026 repricing will be violent, it will be fast, and it will be absolute. Your retirement fund isn't a piggy bank. Right now, it's a hostage. The captors are 7 tech CEOs and a handful of algorithms that don't care if you can afford to retire. This is your wake-up call. The static you hear in the markets isn't noise. It's the sound of the foundation cracking. Don't be the one left wondering what happened when the $7 trillion heist is complete. Get liquid, get educated, and for the love of your future, stop being the exit liquidity for the billionaires. The era of the Magnificent Seven is over. The era of the forgotten survivor is just beginning. Stay sharp, stay skeptical, and I'll see you on the other side of the crash, where the real wealth is made.